Welcome back to Moat. Today we will be discussing EML Payments. First, we will go through the FY 2021 Q1 update, and then we will do some calculations to predict the revenue of EML at the end of FY 2021. It should be noted that I am not going to go through in detail what EML as a company does, so this video assumes a basic understanding of EML operations. If not, I suggest having a read of the article that I'll link in the description, going through some more detail of EML as a company, or just have a read of the publication material online. With that said, let's have a look at the Q1 FY 2021 results. EML recorded a $40.6 million revenue in Q1, which is a 75% increase when compared to the previous corresponding period, and also a 20% increase when compared to the immediately previous period, which is, of course, Q4 FY 2020. The quarter's EBITDA increased to $10 million, which is a whopping 215% increase compared to the previous corresponding period, and it is also a 69% increase compared to the immediately previous quarter. In regards to GDV expanded to $4.85 billion, which represents a 51% increase when compared to the previous corresponding period, and is also a 20% increase when compared to Q4 FY 2020. These numbers are fairly easily understood, and you can see high percentage growth across all three areas. However, there are 2 points that may not be as easily seen and should be clearly pointed out. So the first point is that EML bought PFS. PFS stands for Prepaid Financial Services, and their results have been integrated from the start of Q4 2020. This explains the high growth rates when we look across at all the figures referring to the previous corresponding period. So across all these 3 periods, there are high growth rates, and that's largely due from the PFS acquisition. The second point is that since the PFS data has been included within Q4 FY 2020, it is good to see growth between Q4 FY 2020 and Q1 FY 2021. This means either one or both of 2 things. So the first is that the PFS business is growing between the quarters, and the second is that there is recovery from the slump during the start of the pandemic, which was, of course, Q4 FY 2020. Overall, these are fairly solid quarterly results, and with this as a backdrop, let's have a look now at each vertical in slightly more detail before we go and have a go at predicting the FY 2021 results. So the gift and incentive vertical is the most problematic since there is uncertainty with how well it will perform in Q2 over the Christmas period. Evidently, Q2 is the most important period because this is where most of the GDV in this segment is captured, as seen in the last Christmas during FY 2020 Q2. With coronavirus and shop closures, the GDV captured largely depends on those factors, which happen to be outside the control of EML at the moment. However, it should be noted that while the figure here is 616 million GDV, only 400 million GDV is from shops. So only 400 million is from shops from gift cards. The remaining 216 million are non-shop incentives. The yield in this segment is at 598 basis points, so 598 BPS. Now, if you have a look at the GPR, so General Purpose Reloadable, there is a large increase in GDV, and this is, as briefly mentioned before due to the PFS acquisition. Interestingly, there is an increase in GDV between Q4 and Q1, which suggests that PFS is growing or recovering as well from COVID-19. The yield for GPR is at 110 BPS at the moment. Now if we turn to VANs, so the virtual account numbers, the VANs segment is as expected and has recovered to the previous corresponding period of 2.267 billion of GDV. It should be noted as well that this is not a large contributor to revenue and has a yield of 12.4 BPS. Now that we have some idea of the GDV in each vertical as well as the yield, so the BPS, we can use that data to estimate the annual revenue. There's two calculations. The first calculation discusses GDV and BPS, and this, in my view, is a more accurate approach. So we'll discuss first the gifts and incentive vertical. Let's assume that the Q1 GDV is equal to Q3 and is equal to Q4, which is 199 million from the previous slide. So Q1, Q3, and Q4, you multiply that by 3, and that gives you a total GDV of 597 million for those 3 quarters. And as we mentioned, the Q2 result is the most ambiguous result in terms of the GDV that can be captured because of the Christmas and potential mall closures in the United States and Europe. So let's go under the assumption that the gift card GDV decreases by 50%. So from the data from a previous slide, the Q2 FY 2020 GDV for gift cards was 400 million. We dropped that by 50%, and that gives us 200 million of GDV. The non-mall incentives, I've decreased this by 25%. Why I've only decreased it by 25%? Because there's no clear reason as to why the non-mall incentives will decrease, but I just decreased it by 25% to be conservative. And so that was a 216 mil GDV during Q2 FY 2020. I decreased that by 25%, and now it's 162 million. So we add those two numbers, and that gives us a subtotal of 362 million for Q2. So the total GDV across Q1, Q2, Q3, and Q4 is 959 million, and we get that, of course, by adding 597 and 362. I've adopted the yield of 598 basis points, which is the yield identified in Q1 FY 2021 in the quarterly report. 598 divided by 10,000 times by 959 million gives us a revenue of 57.3482 for the entire annual year, solely for the gifts and incentives vertical. However, of course, there's always a possibility that there is a drastic result regarding the Christmas closures. So it's always good to be careful and identify the worst case scenario. So let's assume that there is no GDV from gift cards. And if we do assume that, I've done my calculations in advance, and that would give us, instead of 57.3 etc. million dollars of revenue, it will give us $45.3 million of revenue. So we'll keep that in mind for our eventual total calculation of revenue. So now let's proceed to the general purpose reloadable sector. And for GPR, it's a slightly more simple calculation in the sense that I've assumed the Q1 gross debit volume, so GDV. So I've assumed that the Q1 GDV is equal to Q2 and is equal to Q3 and is equal to Q4. So if the Q1 GDV was 2.389 billion, so we just simply multiply that by 4 and we get a total GDV for the annual year of 2021 to be 9.556 billion. Again, I've adopted the yield that has been identified in the Q1 FY 2021 results, which was 110 BPS. So we do again the calculation, which is 110 divided by 10,000 multiplied by the total GDV, and that gives us a total revenue amount of $105.116 million for the FY 2021 annual year. Now we do a fairly similar calculation for bands, which is the final vertical of EML. So again, we assume that Q1 is equal to the rest of the quarters. So we multiply that by 4 and we get a total GDV of 9.068 billion. This is a much lower yield, and you'll see that it doesn't generate a large amount. So I've again adopted the 12.4 BPS, which was identified in the report, and that gives us an $11.24432 million revenue amount. If we add up all of the yellow highlighted sections, the total revenue would be $173.7 million for the entire 2021 annual year. And that is an increase of 42%, almost 43%. So in FY 2020, the revenue was 121.6 million. We've calculated at the moment that there is a potential possibility that EML can reach a 42% increase. And if we want to be slightly more careful, we can adopt the worst case scenario regarding the absolute total closure of the gift card segment, and would still achieve a 33% increase compared to FY 2020. So we'd still get $161.7 million of revenue. Of course, you might be thinking to yourself how accurate this calculation is, and of course, there are some assumptions that have been made. In particular, 4 assumptions have been made, and it's useful to pinpoint those assumptions so you understand where the numbers that I've just showed come from. One of the assumptions is that Q1 is historically the lowest quarter for revenue. So the assumption that has been made is that Q1 is representative amongst all 4 quarters. So in this case, the remaining 3 quarters is representative and equal to Q1. So that might not be the case. Q2, Q3, and Q4 can be much higher, or equally it can be much lower. Another assumption that has been made is that there is a 50% drop in GDV for malls. There might be a much better result in that there's a lower drop if the closures doesn't have as much as an impact as one might expect, or there could be an absolute closure, which we've discussed as well. Another assumption that is also made, slightly more subtly made, is that the 50% drop is based on the $400 million figure in FY 2020. So I've also assumed that there's no growth in GDV in FY 2021 Q2. So the 50% drop is based on the figure in the FY 2020 result. I've also assumed a 25% drop in non-mall incentives. There's no solid reason as to why a 25% drop will occur because it's not related to the opening of shops. And also in the FY 2020 result, there was a hint that they have increased their incentives program in an attempt to decrease reliance on the mall sector. So in fact, it might actually be a higher GDV as opposed to a drop. And the fourth assumption is that there is no growth amongst any of the quarters, amongst any of the verticals. Again, that might be true or that might not be true, and this will of course also affect the figures that we've calculated. Overall, I've adopted a fairly conservative approach, and that's to balance against 2 opposing forces, and which is 1, the yield that I've used might not be accurate. It could be a lower amount, and therefore that will decrease the revenue. So the BPS, that's to counteract the BPS amounts that I've used in my analysis. And 2, it's just to counteract also the general risks at the moment regarding EML's operations across their verticals. So that said, that's the first calculation. There's a second calculation which is slightly more simple, and it really just relies on a single line that emerged in the Q1 FY 2021 result, which is this. So the line is that EML advises that they suspect the half-yearly and the half-yearly 2 split of profits to be 48% and 52%. So they suspect this to be 48 and this to be 52. So we can play with those numbers and get the following. So if we assume that the Q1 revenue is equal to the Q3, which is equal to the Q4, so that means each quarter will equal to the first quarter, which is $40.6 million of revenue. And from this statement, we know that Q3 plus Q4 is 52% of profit. So I should have mentioned that I've assumed that the split of profits will also be representative of the split of revenue, which may not be the case, but that's an assumption that I am making here. So the Q3 plus the Q4 will equal to 52% of the split of revenue. And we've put Q3 and Q4 to be $40.6 million each. So that means 52% is equal to $81.2 million. Through simple math, we can calculate how many millions 1% is worth. So 1% would be simply 52 divided on both sides. So it'll be 81.2 divided by 52. And that will equal to approximately $1.56 million of revenue. And also, since the statement has told us that Q1 plus Q2 equals 48%, and we know what 1% is worth from this line here, we can multiply that by 48%, and that will give us the value of Q1 and Q2, which is 74.9, etc. million dollars. So that will give us the ability to calculate Q2 revenue on its own, because Q1 is 40.6 and the total of Q1 and Q2 is 74.9, etc. So just for simple math, subtract 40.6 on both sides, and that gives us Q2 to be 34.35, etc. million. However, and as I've noted here, this is likely a much lower result than that will occur, because if we do the math, we would make more in Q2 by assuming that there is 0 mall and that GPR is normal and that there is 0 vans revenue. Those assumptions are unlikely to occur, and hence it will be likely that Q2 is higher. In any case, if we take those assumptions, the total revenue will be 81.2 plus 74.9, so Q1 plus Q2 and Q3 plus Q4, which would be in total 156.15 million, which is a 28.4% increase. So in this calculation, we get a 28.4% increase still, which is overall a fairly solid increase amount. I wouldn't put too much value in this approach, but it's useful to know just in case if you want to play with numbers. So you can, based on our calculation number 1, use your own Q2 amount and split it between the 48% and 52% ratio and see what revenue figure that you are able to achieve. So with all that said, my personal view would be that the revenue is between $165 to $175 million, and that's, I admit, quite a conservative and somewhat balanced approach. So I have made certain assumptions, and I recognize that there are some assumptions that are made that might not be true, such as the BPS yield. But I think most of the assumptions have been fairly conservative, which makes it not outside the realm of possibility for this revenue to occur. I should also mention that there is always a possibility that the impact might not be as significant as one assumes regarding the mall closure, but there is no way to predict this. But If, for example, that there are fairly favorable conditions that do occur for EML, it is not impossible for the revenue to reach 190 mil or somewhere in that range. This depends on the Christmas results as well as the remainder of FY 2021. However, in any case, increases of 35.7% or 43.9% or within that range is, I believe, a fairly decent amount, which is why I think at the moment EML is quite an interesting share, particularly at the current share price of $3.01.